Hi, this is Ollie and welcome back to Make Money Trading. And this is a broadcast session I'm recording on the 25th of January 2018 and it's called Stock Melt Up ? And I haven't done a broadcast session for actually a few months. I've been on holiday for the last 5 weeks, and also, as I'm going to talk about in this video, the trading environment hasn't been great for macro and momentum trading, and right now it looks like it is starting to set up for a good year, so I'm excited about what's happening and the opportunities. Okay, so today the Dow is over 26,000. I'm sure you probably know that. Just 10 months ago it hit 21,000, so it's over 5,000 points in just 10 months, which is a staggering increase. And 10 months ago I said this in a broadcast video on this program: more money has been lost shorting US stocks since March 2009 than, that should read than, not that, than any other trade in history. Now that's my quote, and I haven't got empirical research to back that up, but that's certainly my strong opinion. And again, just like I said then, we are in the most bullish 6 months of the year. You might want to go and revisit that video where I talk about the 6 months that are most bullish, which is November through to April. We're right in the middle of that very bullish period for stocks right now. And so far this year the Dow is up 6.2% in just 17 trading days. So that's all we've had so far, 17 trading days if you exclude the weekends and the public holiday. And given that there are 250 trading days in any calendar year, that would represent, if it kept on going at this rate, an annualized gain of 91.18% in the Dow, which would be astonishing. I'm not expecting that, of course, but just shows the rate of gains that we've got so far this year. Okay, let's talk about a melt-up. Jeremy Grantham, who is credited with calling the 2000 and 2008 downturns, warned investors to be prepared for the possibility of a near-term melt-up. This is only a few days old, this article, that would likely then set the stage for a later burst, bubble, and a stock market meltdown. So he's talking about a big up move followed by a big down move. And this is what he says: I recognise on one hand that this is one of the highest priced markets in US history. On the other hand, as a historian of the great equity bubbles, I also recognise that we are currently showing signs of entering the blow off or melt up phase of this very long bull market. And Grantham cited an academic paper published last year that said that the strongest indicator of a bubble in US and almost all global markets was price acceleration, and we've certainly had that in the last few months. And he noted that other bubbles, e.g. the dot-com bubble, price went up 60% in the final 21 months. So in the melt-up or blow-off top phase, price can often go up 60%. Now 60% on the Dow would be a further 13,000 Dow points, which obviously if you've got a Dow position and you get a chunk of those 13,000 points, if it does happen, then there's an awful lot of money to be made if he's right. So here is Grantham's summary of his guesses. First, a melt-up or end phase of a bubble within the next 6 months to 2 years is likely, he says, and he thinks it's going to go over 50% up from where we are now, and this is US equities. Second, he says if there is a melt-up, then the odds of a subsequent bubble break or a meltdown are very high, i.e. over 90%. So he's calling a big up followed by a big down. And he also says that if there is a market decline following a melt-up, so the market decline or the down will be a decline, he says, of around 50%. So he is anticipating a very big up move followed by a very big down move, which of course, if that happens, is very, very good news for momentum traders or people who are on it, because you can make money very, very quickly, which doesn't happen very often and hasn't happened for a very, very long time, as you'll be aware. And that's why I say here macro trading and momentum trading is back. It hasn't been around really since 2007, 2008, because when interest rates were lowered around the world by the central banks, that cut volatility and cut trend trades and momentum trades, and has stopped a lot of the great macro traders from making money, and has stopped people like me and many others from having outsized success in the markets, because it's far more difficult to make money in low volatility markets where prices are dribbling up or down. So thank goodness it looks like macro trading is back. And now the reason I'm quoting Grantham is that is exactly what I'm expecting, and it's also the way that I'm currently trading. If you've done much reading around this, there is a wave of international sentiment of growth, international growth, and low interest rates, and also, actually I haven't put this here, but increased earnings for companies, which is driving stock prices higher, and all of those things are propelling stocks higher. So I was fortunate to go long the Dow on the 29th of December 2017, just sort of 4 weeks ago, 4 weeks ago. I'll show you the chart shortly, and I was starting to get a feeling, having read all of this and seen the price action, that price was going to accelerate, and I've caught some of that, which is good. And I'm still long, I'll show you that as well. So let me show you the most successful way I've been playing it. Number one, it is much safer and easier to trade indexes rather than individual stocks, and because of that I'm looking at indexes, and here are the biggest index movers since the beginning of last year, i.e. 1 January 2017. So this is just over a year's worth of data. Emerging markets, the ETF EEM, which captures emerging markets, has gone up 43.3% in that time. NASDAQ just over 40%, the Dow 31.7%, the Nikkei 26.6%, and the S&P 500 25.6%. They are the biggest major index movers in the world in that period. So you can see the US is leading this charge. Okay, let's talk about the Dow. Believe it or not, there have been 202 new record high closes in the Dow since January 2013. So in the last 5 years, obviously there's been ups and then downs, but every time there's been a dip or a down, price has then gone up to a new high, and that has happened 202 times in the last 5 years. And I expect there to be many more of those this year. There have been 9 already that we've gone to new highs. So buying the dips has been a winning strategy for 5 straight years. As long as you bought the dips and had a reasonably wide stop, pretty much whatever else you did, if you'd done that alone, you would have made money in the last 5 years. Now I am not going to go against that trend, at least until there is a crazy melt up or blow off move. Why would I try to stop a speeding train? I'm not getting in the way of that trend. I'm going to go with that trend. So here is how I am playing it, and here is a big warning. I can and will change my mind if the circumstances change. So this is the way that I'm playing it right now. 1, I'm buying the dips in NASDAQ and the Dow using my 4-hour 10 and 30 chart, which I'm going to show you shortly. I'm buying the Dow using the weekly pivot as a stop, i.e. I'm using the weekly pivot as support and resistance, and I'm going to show you that as well. I'm also looking to buy the EEM Emerging Markets Exchange Traded Fund. I'm not long at the moment, but I want to buy it using my 4-hour 10 and 30 chart. And I am long Kiwi USD, which is highly correlated with stocks, and of course also profits from the weakening US dollar, which is another global macro theme which is very profitable right now. Okay, let's go and have a look at the charts, and I'll explain what I've been talking about. Okay, so here is an hourly chart of the Dow going back to November 2017. So obviously each of these bars is 1 hour. The thing that I want you to concentrate on is these lines here, because those are the weekly pivot lines. Now if you had gone long the Dow on 21st of November, and from then on used the weekly pivot, this line here, which obviously gets created every week, if you'd used the weekly pivot as a stop, you would still be long, and you would have had multiple opportunities to make money. So let's have a look. We'll just go through the chart and have a look. See how it comes down, gets close to, and never goes below the weekly pivot. Here it touches it right on. Here it doesn't even get close. Here is the only time it really flirts with it, and Mondays I ignore. Mondays are a funny period of the market because there's low liquidity, so Monday morning before the US market even opens, not concerned about that. And you certainly wouldn't put your stop right like 1 pip under the weekly pivot. You'd put it sort of 30 or 40 or 70 points below. And you can see actually I got long using a different model, but I looked at the weekly pivot there as well, and that's the first of my long positions on the 20th, actually that was the 29th of December, as you can see. And ever since then, again, it's stayed above the weekly pivot, and again you can see I've got one entry there, got another entry there, and I've got another entry there. And this one especially, I've used the weekly pivot as my stop. So yep, only if it breaks down below the weekly pivot will I get stopped out. So I've got 3 current Dow positions. I've lifted my stops on 2 of them, the other one is sitting there, and I love using the weekly pivot as a stop, partly because it's working so well, and partly because you might remember the massive up move in silver in 2011, and I put a separate video out then about using the weekly pivot to go long and stay long silver on that massive run up, and the weekly pivot held the price for week after week after week after week after week. If you just used the weekly pivot and no other strategy whatsoever, that would have been a profitable strategy, and that's exactly the case on the Dow right now. And also it's going to be an early warning sign. If the Dow breaks cleanly below the weekly pivot, that to me will be a warning sign that perhaps there is a little bit of turbulence ahead, and I'm just talking about temporary. I think that until the end of this bullish 6 months period, until the end of April and into early May, I think as long as there's not a Twin Towers event or an impeachment or anything like that, other than a wild event like that, I think price is just going to march upwards and make new high after new high after new high. Okay, let's have a look at the 10 and 30 model that I talked about. Now, you will be familiar with the fact that I especially like the 8-hour 10 and 30 model, but in accelerating markets you actually need to change the perspective, because coming into this moving average buy zone is much more likely in accelerating markets in the 4-hour rather than the 8-hour. Let's click over the 8-hour and see that there are still opportunities using the 8-hour with and remember, these are just simple moving averages, 10 and 30 simple moving average, and in fact that position I took there was based simply on this 8-hour moving average, the moving average buy zone, but you're only getting occasional touches in this moving average buy zone on the 8-hour. So because price is accelerating away, I'm now going to what suits the instrument better, which is the 4-hour chart with the 10 and 30 moving average. You can see actually that I've got a order in here. Now I love this setup here. It doesn't mean that it's going to make money, of course not, but I love the setup. We've got a big down candle followed by, now we're onto our third candle, which are all small candles in the moving average buy zone. I'm waiting for a break above this candle. I could put my stop below the low of that candle, but that's very tight. So I've brought my stop all the way down to the bottom of this candle, just to give me the extra protection in case there's a bit of volatility. But even there, it's a very low risk trade because my stop's down here, and I'm of course expecting price to go up in here. I could even more aggressively play it by putting my stop just down below that candle. That's only 20 odd points. This is the NASDAQ. It's only 20 NASDAQ points, which is fairly small, but a very aggressive way to play that would be to, again, the whole point of this is to buy as if it goes 1 pip or 1 point above this candle, which if you look in the bottom left hand of your screen, the high is 6939, So I'm pretty sure my buy order is actually at 6,940 and my stop is just below the low of that candle. And again, there's no guarantees this will work, but I love the setup, and what I love most about it is it gives me an opportunity to add to my existing position. I've already got 2 positions on board. I'm looking to add a third, and it's a very low risk, high profit opportunity, and that's always what I'm looking for, an asymmetric opportunity to trade the markets. So here's the final chart. This is EEM, the Emerging Markets ETF that I said I'm trying to buy. I wasn't trying to buy it in here, unfortunately. This is a perfect setup. We've got small candles in the moving average buy zone. You could have used a break above that candle, or you could wait for that candle and take the break above that one with a stop below there. But I'm waiting for it to come into and at least touch the moving average buy zone. Now I could of course buy it here, but the problem with buying it there is that price always, with a capital A, always comes back to the moving average buy zone. And if you buy it up here, the risk reward is not good enough, because where are you going to put your stop? You might even have to put it way down at 50. So you're better off waiting for one or two small candles in the moving average buy zone. Have a buy when it breaks the high of that candle and a stop below the low. So I'm waiting patiently for there to be a pullback into the moving average buy zone. And actually, let's throw in one more chart. This is Kiwi USD. Now this is not accelerating upwards as fast as Dow and NASDAQ, which is why I'm using the 8-hour 10 and 30 moving averages. And you can see there's been opportunity after opportunity after opportunity after opportunity, and potentially one now, although these candles are a bit big, but there could be a setup for another opportunity. You can see I've got long, and I am happy to be long, but if there was another opportunity with a small candle in this moving average buy zone, I would look to add to my position. Again, just changing the time frames to suit the price action of the instrument. Okay, that's it for this video. Happy trading in 2018. Please let me know what you are seeing in the markets. I'm very interested. Have a fantastic week, and I hope this market continues to ramp up for the next few months, and maybe we can all profit from it. Take care.